So the theme of today is broken capital stacks, not broken deals. The first thing that you have to understand here is this is what we call the slow strangulation era. This is not 2008 where a big tsunami has come, washed away everybody, and basically everybody's desperate, and anybody with a little bit of cash can essentially show up and command their own terms. That's not really what's happening right now. And we have plans in 2026 for acquisitions and developments. There's specific reasons for that. This is just going to cover acquisitions and more specifically distressed acquisitions where the borrowers and lenders alike are in some level of stress or distress. And how does one step in and how does one actually frame this sort of how do you view these things basically, right? So the core thesis here, which has actually been proven out by us now, in that in this cycle, this is a rare window where sponsors with network, pedigree, but most importantly, actual operating experience. And this actual operating experience is very, very, very important. These types of sponsors, not just people with some cash is very important, don't get me wrong, but people with real networks, real relationships, and most importantly, a track record of operational excellence can basically have a generational buying opportunity where they can negotiate favorable terms with stressed and distressed, by the way, borrowers. So think about it on pricing as an example, or stressed or distressed lenders. That problem has not been solved because for the longest time we were in an era where interest rates either kept falling or they weren't rising fast enough. So you could sort of paper over the cracks. Lenders extended and pretended ever since interest rates started going up. And the issue now simply is you cannot be in a business where all you are doing is being a paper pusher, right? You get a deal, you try to flip out of it. You now need to have operational excellence. For now, though, the stress and distress, by the way, is somewhat contained in the sense that lenders are making selective decisions. There isn't like this dam that has broken. It is slowly breaking away and chipping away. But lenders also realize that if they just give up and the whole dam breaks, then nobody wins. And most importantly, lenders don't win. And the biggest reason there is they've tried working with these borrowers. These borrowers, and some of these borrowers are actually very thoughtful people. It's not like they're all stupid people. It's just sometimes you're in the wrong place, wrong time, right?
Right.
Things happen to the best of us. So they've tried working with their current set of borrowers. Either those borrowers do not have any money, have not exhibited a desire to put in any money, or some combination of they can't put any money, they do not have any liquidity, and now the lenders also need to find a way out. Because a lot of times people think that if a borrower is in trouble, right? They say, oh, your borrower is in trouble, this deal is going sideways. Well, yeah, the borrower is in trouble, but typically the lender is the biggest stakeholder. So the lender is also sort of in trouble.
Thanks, Omar. So everyone, before we go further, I just want to be respectful of time. This honestly is not probably a good fit for people who need high liquidity. This might come as a pretty straight point, but these opportunities typically require 3 to 5 year hold. It's also not designed for investors whose strike point is north of 20% IRR. I know that might come as a disappointment, but these are not the point of these are not to be home runs, and with that they're not high risk plays. And finally, if you're looking to fill the speculative portion of your portfolio, this likely won't resonate as well. The strategy is about basis, downside protection, steady cash flow, and honestly not swinging for the fences.
So Miles, why don't you pull up the delinquency charts that we were, our team had pulled up from
Yep,
Trip.
yep, absolutely.
And again, guys, I'm going to go over a couple of these things. We want to keep these things short. If there's any items over here that, are too technical, you're too hazy about, please feel free to reach out. Miles, why don't you just zoom in a little bit over here? So as you can see over here, this is from TREP. TREP is one of the leading providers of this data in real estate, and especially in our line of work. And as you can see, there is a big spike up, number one, in February. So delinquency rates by major property types have been going up. In fact, recent data is suggesting that they have doubled year over year, as you can see on that chart as well. And it's not just say the absolute number over here. right? Hey, the absolute number is one versus two or three versus four. It is also the growth rate at which this is accelerating.
Omar, when we're
Like,
talking about delinquencies, what are we talking about? Again, just to make sure that everybody's aware, what are we
so
looking at right now?
So delinquencies in this case are defined by somebody either not paying their mortgage payment, partially paying their mortgage payment, right? That's literal definition. But in a lot of cases, watch listed loans are also loans where the borrower or the lender has proactively watch listed them to say, hey, I am making my payment right now. In 1, 2, 3, 4, 5 months, I will either not be able to pay my payment, I will not have the liquidity to do it, or some event happens which they're effectively not going to be able to pay it.
Right.
Right? Let's assume your taxes are getting reassessed at a number way higher, or your insurance is spiking up way higher, or some combination of these items. So this is just looking at that, but there's other data to show also that watch listed loans, that absolute number is increasing, but more concerningly, the acceleration part is increasing. And the reason why this is important to look at it over here is because this is pointing to a secular trend. Because it's that old saying that nothing happens and then everything happens in one go. So what you're seeing over here is that lagging effect of interest rates increasing by 500 bips. That's what's going up, right? And that's kind of important to understand because you can see that all this lagging effect over many years is now finally catching up. And a lot of like the rearranging the deck chairs on the Titanic that people were doing, maybe sponsors were reaching into their own liquidity pool, their own money, maybe they went to talk to their investors. Well, all of that thing is going away now because frankly, people are exhausted, investors are exhausted, sponsors are exhausted, and frankly, lenders are exhausted.
Mm.
And as this spike continues, the more delinquencies happen, the more opportunities start being created. But again, these are, while the acceleration is very high, they're still in a manageable amount that lenders want an orderly liquidation. Because when there is a disorderly liquidation, when there is chaos and panic, then the biggest stakeholder in the transaction, which is the lender, lenders will lose. They don't want that. They've learned their lesson from 2008. And as much as possible, they are trying to manage these scenarios to ensure that they can, sort of consume this in bite-sized chunks. But we all know the longer this thing happens, the more delay it happens, the worse these things will become. So let's go to that maturity wall. And I think that's also kind of really important to understand. Now, the maturity wall basically, yeah, zoom in a little bit over here. The maturity wall basically shows you over here that how many loans are coming due this year, right? Or for the next remaining few years. And the reason why it's important is because as these loans come due, you have to understand these loans are some combination of 3, 5, 7, or 10-year loans mostly, which means that these loans were originated, which means that the instance of when this loan happened, that was a completely different time. Rates might have been zero, whatever, 1, 2, 3, 4%. Now the same rate might be 6, 7, 8%, depending on what type of product you're going for. So effectively, your debt servicing cost has gone up. So your mortgage has gone up, sometimes in some cases double, and your values have gone down.
Right.
So you're getting hit both ways. Think about it this way. For all the folks, think about it in very simple terms. We've been hearing in the news a lot of people that bought homes when rates were 2 or 3%, even though they want to move to a different location, want to get a new job, they can't because they realize, hey, if I sell my house, now I have to go buy a new house that is probably way more expensive because I bought my house around COVID time or slightly before, but my mortgage is also going to be way more. So I'm getting hit both ways. The value of the house is more. In this case, the value is down, but the point remains the same that you're getting hit both ways. Your mortgage has actually gone up, and the rate is the biggest contributor to this cost. And the reason why this is important is because you can see that this is not a case of like 1 or 2 years where your maturities are, they're spiking and then they sort of decline. So as long as you survive those 1 or 2 or 3 years, you can sort of get by. All the way to 2030 at least, there is a huge amount of maturities that are happening. And because these maturities are happening, what happens as a result is that there is a lot of pressure building within the system. It's not like it's not like, hey, you go from 2030 to 2031. So you survive till 2030, which is pretty long into the future. And 2031, you get a lot of relief. People are breathing easy, they can figure stuff out and go from there. That's not happening. And that pressure is on borrowers as well as lenders. So they have to come up to a solution. There is no way, there is no solution happening.
Um,
Again,
Omar, is it
these
fair to
guys are
say
ready.
that, and is it fair to say that 26, 27, there is a concentration? I know there's a little bit of a drop off in further years, but there seems to be a concentration in 26 and 27. And if that's the case, why?
Okay, the reason why there is so number one, you are correct, but a big reason for this also is that a lot of loans were originated 2020, 2021, and 2022. That is peak COVID era. Interest rates were really low. We saw across the board housing prices, commercial real estate prices just shoot through the roof. Well, eventually, the chickens have come home to roost because unlike say a conventional 30-year housing mortgage, your typical loans in commercial real estate, or at least in multifamily, are 3 or 5 years with some 7-year exceptions, right? There's 10-year loans as well, but the bulk of the market is 3 or 5 years, and those loans are coming due, or you have to basically pay them. Now what happens is typically sponsors would roll over these loans, which means, hey, I've had it for 3 years. If I haven't sold it, most likely I've increased the underlying revenues, I've increased the underlying net operating income, which means I have more income, which means I can qualify for another new loan and start buy myself more time. Well, the problem is because so many people were buying these products, more and more development was also happening. So you're having supply hit the market. So now demand 101, demand supply 101 says that if there is demand, but there's more supply for a product than demand, your rental rates have come down. So your rental rates have started coming down. Now they're inching back up now from this year on, right? Your rental rates have come way down. Your debt servicing costs are way up. Your mortgage costs are killing you. Your insurance costs are through the roof. So basically, your revenue is collapsing, expenses are going up, and your mortgages are killing you. So what's happening now is there is no margin left in the business. And a lot of these folks that bought assets there, they're basically dead in the water. They can't get a new loan. Or if they can get a new loan, they just have to put so much more equity into this project that it might as well mean they can't get a new loan. I mean, that's effectively what it means. So that's why understanding this maturity wall is very important and realizing that this is not a 1 or 2 year game where, yeah, you kind of sort of survive and then you kind of play these little financial engineering games and you're done. No, this is this is a real structural problem that needs to be solved. So let's go to the next little thing about our bridge lenders. And bridge lenders are the short-term lenders, which are very popular. 2020 to 2022, a lot of the distress you hear about, a lot of these lenders now, ReadyCap being one of them. I'm sorry, I don't want to pick on them. We all have our problems. ReadyCap, this is publicly available data, guys. Everything that we've shared here, if you need anything, please reach out to us. All of this is publicly available data. You do not need to subscribe to any fancy database like we do. You gotta realize ReadyCap is willing, has their loan books out, which means their entire loan portfolio that they have originated, they are wanting to sell these loans anywhere between, I don't know, 60 to 70%. So for $100 of loans, they are trying to sell these loans at 60 cents to 70 cents on the dollar, and they are barely still getting any buyers. So think about it. The lender that was lending at say 70 or 80%, which means if you acquired a property for say $100 and the lender gives you 70% leverage, which means there's $30 of equity, $70 of debt. Well, $30 of equity has all been wiped out. So now the lender's $70 basically in that is being valued at anywhere between 48, so what is it, right? So yeah, 48 to 70, somewhere in the 48 to 54%, $54 mark. So effectively, an asset that was acquired by the last guy at $100 is being trying to be shopped around for anywhere between $48 to 54, maybe $60. See how much of a drop that is. And again, I'm not trying to pick on these guys. There are numerous examples. We've talked to so many lenders. This is a pervasive problem across the board. And these lenders are also running out of time because, again, one of the underappreciated things that people don't realize is lenders also have lenders. So if some person decides to have a debt fund, They also go to the bank, like a JP Morgan or Citibank or Wells Fargo, and they say, hey, look, we are going to run a debt fund. Give us some back leverage. So we'll raise $100 million. You give us $200 million. Now we've got this $300 million, effectively a credit card, and we're going to go originate these loans and we're going to sell it in CLOs. CLOs are collateralized loan obligations. So we are going to package all of these loans and we are going to sell it into the market to fixed income borrowers. So think about, some old retired couple that wants to make monthly income. Well, these loans get all pooled up, sold to the market, and then those mom and pop investors in Florida, or as an example, they get their monthly checks from these types of things. Now, again, they don't know about it, but that's actually what's happening. Now, if you look at basically the CLO structures, and again, this is all publicly available data, these are publicly traded entities. The CLO structures basically are, again, we can scroll down. The CLO structures basically, uh, I mean, they're forcing deliberate harvesting. You can scroll down, basically, keep scrolling down, right? You can see it's publicly available data. Yeah, we can get out of this. There are lots and lots of these lenders that have their own lender at the back calling the money. But that lender now realizes, oh, crap, these guys can't go sell their asset and reclaim their money. So now they are playing these financial engineering games of extend and pretend, and all they want to do is find a credible operating partner. Because for the longest time, since say 2011 to 2021, the business was, well, you don't really need to operate these assets. You just need a warm body. Somebody that can walk and talk should show up to this business. And if things don't work out, we'll just flip the asset and try to make money. It's a greater fool theory, right? A bigger fool than me is going to show up wanting to buy these assets. Well, the chickens have come home to roost. It's not that easy. Now you need operating partners that can actually operate, understand how these levers are, how to pull these levers. That's where folks like us come in. So, Miles, to cut a long story short, what are some current investor pains and what's the remedy over here?
Sure, sure. So as we look ahead to 2026, we've been listening closely to investors across the market, and the message has been honestly remarkably consistent. Many of the old real estate models are under strain, like Omar had mentioned, and investors are looking for structure that work in this current environment. And when we look across portfolios, the challenges tend to fall into four core points. And our 2026 strategy honestly was built very intentionally to address each one of these pain points. So the first pain point I want to talk about, and this might resonate with some of you, is halted or reduced payouts. So firstly, we're hearing a lot about halted or reduced payouts. Investors are stuck in deals where distributions paused, not because the assets necessarily stopped operating, but because the capital stack was broken. We've seen this play out firsthand across the market and within portfolios we've been involved in, where floating rate debt, rising reserves, and the lender mechanics quietly diverted cash flow away from investors, even while properties were still occupied and collecting rent. That experience directly shaped how this structure was designed. So, the solution for this first pain point is to prioritize structures where distributions are designed to come from ongoing operational cash flow. This has come up in many of my conversations with potential investors, with real-time investors, and operational cash flow again is where the distributions come from, not from refinancing assumptions or future capital events. That means for us focusing on stabilized assets with in-place income and a defined cash flow preference aligned with actual operating performance. The second pain point is overall uncertainty. So the investors are tired of business plans changing midstream because assumptions broke or the market shifted. Pardon me. The solution in all of this is strip out as many moving parts as possible. We focus exclusively on stabilized assets that are already performing today. These are not speculative business plans that require perfect execution. They're assets producing income now, which restores predictability. Again, a key word right there, predictability. The third pain point, and one that we have done a lot of digging on and had a lot of conversations about, is tax burden. So many investors are facing capital events and looking for ways to offset gains while keeping capital productive. So these investments that we want to talk to you about, and we're looking forward to in 2026, they're structured to take advantage of current bonus depreciation rules where applicable. While tax outcomes are investor specific, the goal is to reduce taxable exposure while continuing to earn passive income. And the fourth and most important pain point is downside risk. So, in today's rate environment, traditional value add strategies leave very little margin for error, right? The renovations that were so popular in 2022 carried risk. Developments can even carry risk. Lease ups can carry risks. Deals can no longer rely on aggressive rent growth or appreciation to bail out the capital stack. So, the solution to this pain point is we protect the downside through conservative structuring, most notably securing long-term fixed-rate agency debt. And that includes 7-year agency refinances where applicable. You know, Omar and I have chatted about this as well. We've seen 5 years, 7-year fixed rate debt right now. The 7-year is the most affordable. So by acquiring assets at a low basis, eliminating renovation or development risk, and locking in fixed rate, we aim to ensure, again, operating cash flow covers both debt service and investor distributions, even through market volatility. With that context, Omar, I'll hand it over to you to walk through what opportunities actually look like in 26 and 27 and how the strategy is being implemented in real assets.
So thank you, Miles. So look, I've got a couple of my notes over here because we have all we like. I think we're in the business. We're too close to the action. So I had my team put together a summary of these things. So number one, the real opportunity y'all have to realize is across the board, housing affordability or rather unaffordability. It continues to be a problem. This used to be an issue if you lived in, say, the coast. You were in a California, you were in a New York. That used to be a problem. Now it's across the board. I live in Dallas. Dallas was always considered an affordable place, a big city, lots of job and employment opportunities, but still very affordable. So every part of the spectrum you could sort of, every part of the value chain you could sort of come in and then sort of build your way up. Well, people in Dallas are getting priced out. I know if you live in California or New York, this is alarming to you because things look relatively cheap, but people in places like Dallas are getting priced out. People in places like Tampa are getting priced out. So housing unaffordability continues to be an issue across the board. We are a fast becoming a renter nation now. And I've got some stats over here. Look, the average, and this is across the entire country. So if you hone in on areas of growth, things like, say, California, Texas, Florida, these stats are going to be even more alarming. But across the board, according to Harvard's Joint Center for Housing Studies, wow, that's a big name. There is a 5x a home price to income ratio. This number used to be way less. It was around the 3.5, in some cases 4.5 number. So you've seen what a big jump this has happened. And this is a step change after COVID. There is still a 4.7 million housing unit supply deficit. This is from the Zillow analysis of 2023 census data that they did in 2025. So what does this mean? This means that quality affordable housing is still a problem. It's not gone away. It's not like suddenly house prices are going up or apartment rents are going up and people are like, well, you know what? I'm just going to go live in my car. That's the sort of the last resort. People still want a quality, affordable, nice place to live. And the issue for us, though, is in our line of work, is that there is a complete dislocation here between fundamentals. The fundamentals are extremely strong. Our leasing activity has never been better. I mean, people are showing up wanting to lease houses. But the issue is that because of the greatest velocity of interest rate hikes, I think this was like 500 bips in record time. This has never happened before. What's happening is even a lot of these stable assets, they are having stable assets, thoughtful sponsors, good markets. They are having trouble just paying their loans. So there is a huge dislocation in the market. It's not a demand problem, it is a balance sheet and capital financing problem, which leads us to the fact that the opportunity now that we see for the next 1.5 years, maybe 2 years at most, but it's definitely I feel between 12 to 15 months mark is we're sort of at a bottom of a cycle. This is because there is ample distress from debt, and that, by the way, that distress is increasing every week, it seems like, right? And not because of, say, people don't know how to manage these assets. Existing owners cannot come up with capital, new capital. Their investors are exhausted. They've run out of money. They just don't have enough capital. But the market is moving from the cyclical bottom. There are early signs of expansion, like the market is on the way up. Couple of big reasons. Supply, which was the big boogeyman for a long time. We had record amount of supply in the apartment space, and this hadn't been seen in 50-ish years since the 70s. Well, that supply is pretty much all absorbed, which means all of it has been taken up and there's not a lot of supply after that. But demand continues to go up every week, every month, every year. So with interest rates coming down, demand going up, supply going down, the market is now turning into a net positive, but it's turning into a net positive for people that can capitalize on the opportunity. So even though you could be a great operator, you just happen to be in the wrong place at the wrong time. Well, the market might be going up, but you've run out of time. So effectively, it's not really a good deal for you. So the proactive response over here is that these are balance sheet plays, but you have to partner with the right operators, acquire stable assets in stable markets. So growing assets, growing markets. Please don't go into the boondocks. Don't go to this tertiary market where your uncle's cousin's babysitter lives and try to buy like apartments. That's not going to work out. You want to move to big, solid, reputable top 15, top 25 MSAs, acquire stable assets at very attractive pricings, resolve these lender issues and debt issues by effectively negotiating, understand how these structures work. This requires a level of sophistication which the average real estate sponsor does not have. They need to have capital markets and legal expertise on hand, and then reposition using the operating platform with very hands-on asset management. Because again, even if you resolve the lender issue, even if you acquire great assets, your lender is compliant, they bring a new body in, you renegotiate everything, but you do not have hands-on asset management, things are just not going to work. Period. End of story. This, we are going back to a market where fundamentals and operating excellence matters. So, like I said, we have locked in strategies for, and I'm looking over here, we've locked in strategies for developments and acquisitions for 2026 for investors who prioritize, asset acquisitions and getting immediate and consistent cash flows. This is the play. Reach out to us for any clarification if there's a lot of technical words or if I was really fast or didn't really explain anything on how this fits your, how you want to learn, how this fits your strategy, what kind of task considerations you should think about, because that's also a big part of this angle, and how you're looking to deploy capital. We're more than happy to help you and guide you. Look, the majority of our offerings are for accredited investors, but we may have some room for non-accredited investors from time to time. We've got a couple of funds. Reach out to Miles at boardwalkwealth.com. Miles, why don't we open up for some Q&A, because I think we're getting some, right?
Yeah, absolutely. Like Omar said, so now we've covered the framework, the opportunities as we see it for 26, 27. Let's open it up for questions. There is a little question box on your screen. Let's start plugging them in. I've seen a few questions go up, Omar. Let's give everybody a minute. One of the questions that came up quite early in the talk was, why not just wait until 2027 to see if prices drop further, if the market shows clear signs?
Well, it's a chicken and egg problem, because presumably, if you see the all clear signal where money is falling from the sky, operations are improving, everything is good, presumably other people will also see it. And these are people that are not just in the industry, but just generally people. So then you come back to the same problem. You don't have a borrower and lender that is willing to play ball, because typically you have a compliant borrower, but not a compliant lender, or you have a compliant lender, but not a compliant borrower. Right now, there is this golden opportunity to squeeze on both hands to get the best possible terms. So unless somebody has the ability to see the future, say a month or 2 months before other people do, this waiting and it's not really going to work. We've waited for 3-4 years. Now is the time to capitalize on it. And look, we've actually done it over 2,000 units. So we've done this enough times to sort of understand how these things work. And guys, again, you have to understand, real estate, by definition, a lot of these deals are like slow moving deals. Even if you have all the money in the world, getting through your thirds, your DD, your PCRs, your all of this stuff, this takes at least 45 to 60 days. Like if I show up with all the money in the world and the agencies are willing to give me money because I'm an approved borrower from Fannie Mae and Freddie Mac, that process still takes 60 to 70 days. So it's not like you just come in, you do go like this and then you can acquire all these assets.
Right. So, with that all said, are we relying on the Fed to cut rates to even make this work?
No, not at all. The Fed actually does not factor as much into this at all because now we've actually absorbed the shock of the Fed actually raising rates. If anything, the Fed is actually cutting rates, and that's still not affecting real estate valuations right now, materially, like the way they went up and how the price is created. This is merely an opportunity where if you take today's rates, you take today's fundamentals, but then you reduce the price at which you acquire, you're effectively in the money the day you walk in. And in most cases, just the tax write-offs alone make you so in the money the day you walk in that, again, but this type of opportunity only exists at cyclical bottoms. Think about the after effect of 2008. Now, it might have been mentally taxing to acquire assets of any kind, say in 2010 as an example. But all the people that did that, you don't hear them complaining about it. Because every time there is a cyclical bottom, that is the time to gobble. That is the time to acquire a lot of assets because you're going to get pricing that you're frankly just not going to get in a more orderly market.
Right, right. There's a few more questions coming in right now. Just a reminder, if there's any questions around portfolio fit, cash flow, downside protection, tax, and timing considerations, we would love to hear them. If anything's on your mind, please do let us know. Okay, here we go. This is a good one. This person asks, fairly new to commercial real estate, would love some clarification on how do sponsors structure offerings for both accredited and not accredited investors? Are they placed in the same deal or are they separated?
Okay, so look, I can't talk about other folks. I can only tell you what we've done in the past. Um, Maybe that helps you, maybe that doesn't. So for us, the way we look at it is it's not like how the we structure the offering. It's the law. So there are, at least for the types of work we do two types of offerings. One is a Reg D 506B, B as in ball offering, and one is a Reg D 506C offering. So for the former 506B, B with ball, we can accept a limited number of non-accredited investors. The SEC and the securities laws allows us to do that. The con of that is that we cannot publicly advertise. So we cannot literally go to the entire world publicly and say, hey, here's a deal and you should invest, right? Pros and cons, right? We can only go to people that we have a pre-existing relationship with. That's just the way the law is. That's the way it's structured. If you can take a non-accredited investors, the law is very, very, very clear on that. Now, the other side of this is if you want to publicly advertise. That is, at least for our line of work, a Reg D 506C offering, C as in cat. Now, there you can only take accredited investors. They have to provide you accreditation documentation, but you can publicly advertise your transaction. Think about it. I mean, if you want to go put a billboard, you can go put a billboard. You want to advertise on Facebook? I guess go for it. I mean, we don't really do it, but I guess you could go for it. There's no hindrance, but you can only take accredited investor money. And the next part of this is, are these investors typically placed in the, yeah, you could have a deal that has non-accredited and accredited investors. It just depends on your filing 506B, 506C. You don't have to separate them out. At least we haven't done it in the past. And what does the overall fund structure look like? The overall fund structure is basically dependent on what the sponsor is offering. Each sponsor would have a different strategy. More than happy if you reach out to Miles at Boardwalk Wealth. Are more than happy to talk about it and walk you through what our structure is and what we see are some common pros and cons and pitfalls that you should be watching out for, whether you're investing in our deal or somebody else's deal. So more than happy to do that.
Omar, this is a good question. We've all been watching for distressed deals now for a few years. Why are you so confident saying this is a sign of the market cycle changing?
Well, I can tell you that the conversations I had 3 years ago were people saying they wanted to get distressed deals. but nothing was really happening because the borrowers weren't playing ball and the lenders were not playing ball. And you have no amount of, you have guys, Miles knows this. Every single time we talk to a lender, they tell us, we have no problems. All of our loans are great. And then I can take out my phone, go to say something like TREP or Real Capital Analytics, because you can see all the watch listed loans. These are publicly sold, right? And CLOs and all. We say, okay, that's great. It shows over here, according to the latest public filings with the SEC, that you have 20 loans that are distressed or watch listed. Would you like to talk about that? Right? So that stuff that wasn't happening is now happening, number one. Number two, people, even a year ago, lenders were telling us, most lenders, we're not going to take any discounts. Don't want to take discounts. Don't even care. Pay us our 100% of money or nothing. I don't really care. I'll figure it out. Well, now it's a very different tune
Yeah.
because as the passage of time occurs, more distress happens, more of their borrowers basically start falling by the wayside. And you also have to realize a lot of investing is, especially in real estate, is that old saying that hope springs eternal. A lot of borrowers that are not financially sophisticated, especially, just thought they could wish it away. You just thought, look, these rates have gone up, they'll go down in a year, and everybody had their own pet theory, and we laugh about it internally a lot. But these rates aren't going away. But
Yeah.
it's like going through what is it, the 5 or 7 stages of grief. You kind of sort of have to go through them. And if you do, and if you kind of skip one stage, your grief process doesn't really fully finish. So we're now at the last stage of the grief before there is an acceptance.
And in real time, we've seen really like the sad state of affairs which exists right now, which is, and again, we're just to reiterate, broken capital stacks is what we're talking about. We've seen operators that have high occupancy. Their rent roll looks reasonable, Omar, but still they can't make the debt service. And that's putting serious pressure on these deals to exchange because the capital stack, again, is dysfunctional at its core. The properties themselves are doing just fine in a lot of ways.
100%. I mean, look, that's just the way it is. Like I mentioned, a lot of times people think these are people who should have known
Yeah.
and why are they doing this? No, some of these are very thoughtful, seasoned operators. They're great people. They have awesome teams. You're just wrong place, wrong time.
Yeah. Yeah. What we're also seeing is that lenders are offering extensions, but those extensions come with cash sweeps and higher spreads and huge extension fees that completely erode equity over time. So, waiting is no longer neutral, I guess is the right way to put it. It's really destroying anything that would exist to make these properties function.
100% I agree with you. Again, guys, it takes time for these things to happen. People think that something happens and tomorrow everybody's just going to give up. No,
Yeah.
people have worked really hard to get to where they are. They're just not going to give up. They're going to fight, and eventually they might get exhausted, but they're not just going to give up. These are
Yeah.
thoughtful, intelligent people. We're in a market with very thoughtful, intelligent people. Honest mistakes can be made, but they are mistakes and stuff has happened. And by the way, this is not just a failure, say, on behalf of the borrowers or the lenders. Think about it. It's a failure on behalf of many big institutions that have taken hits. I mean, people talk about oh, this type of profile of person is dumb and that type of profile of person is intelligent. Well, all the big players, we're talking people like Blackstone, KKRs, Brookfields, Apollos, Ares, they have all been foreclosed upon. Billions, yes, billions of dollars of their real estate that they owned has been foreclosed upon. This is not a case of like some syndicator out of like, say, San Antonio or Dallas getting foreclosed upon. Some of the smartest people in the room, they have had multiple billions of dollars of real estate foreclosed upon.
Yeah.
This is a
Yeah.
systematic, system-wide issue.
Yep. We have one question here. What's our geographic focus or exposure?
Oh,
Where
our
are we?
geographic. Oh, that's yeah. I'm sorry, but say that again because that's a very easy answer for us.
What's your geographic exposure or focus?
Our exposure and focus on acquisitions from day one has been the Sun Belt, predominantly the Southeast.
Mhm. And why? Give us some reasons as to why that is.
Well, look, so one part of this could be as dumb as we are just living here. So we have ease of access to all of these markets. We live in these markets. We meet the people in these markets. We're fully aware of all the good, the bad, and the ugly that goes on in this market. And the other concept is very simple. I have actually lived in the Socialist Republic of Canada. And I can tell you how brain damaging it is to live in a city. I love Toronto. I went to school there. I think it's one of the best cities in America, North America for sure, maybe soon to be America, right? I love it. But being a residential owner in those markets is brain damaging. Ask anybody that owns apartments in places like Toronto, Vancouver, San Francisco, Los Angeles. I mean, Los Angeles is pretty much redlined by most lenders. You cannot run your business, or at least have the business that we're running, in those markets.
Yeah, yeah.
So, yeah, frankly, I don't want to deal with that hassle. I want to provide good quality, affordable housing. I want to have professional management. I want to provide the best possible experience. And the only thing we ask in return is please pay your bill on time because we have to pay our bills. We have to pay our people. We also have to feed our families. So
And the and,
that's it.
and the
We
and
don't
the
have to be best
premise
friends. Yeah.
and the premise of this webinar, it applies nationwide, but I think that question really will be answered differently pending the sponsor, right? So for us, like Omar said, Omar's based in Texas, based in Georgia. We're very familiar with the Sun Belt. We've owned and operated in the Sun Belt. When you have assets in close proximity to one another, there is that ability to share resources and to understand the market and to utilize relationships that you have in those places. And when you start to branch off too far, having a property 500 miles away from the majority of your portfolio is problematic for us as operators.
Yeah, I would agree with that. You have a more eloquent response than mine.
I wanted to badmouth Canada. You just beat me to the punch. Okay,
I
you beat
love
me to
Canada.
the
I just
punch.
want to point out, I love Canada. I loved living in Toronto and Calgary, but there are structural issues in terms of running our business, which just make it impossible to run our business there.
Yeah, yeah. That's really the best answer for that question is both of us lived in Canada for a short period of time, and that's why we picked the place furthest away from Canada, and that's the Sun Belt.
Yeah.
Are there any other? Oh, we got a question. Let's see. For a 5 to 7 year hold, how do you project target rents for a specific submarket? Which data sources or databases do you typically rely on for these assumptions? So I think the biggest, well, I'll quickly answer. Our target hold for this premise is a 3 to 5 year hold. But Omar, why don't you continue to answer that question?
I mean, you're pretty close to the action. Why don't we hear you give us the answer and then I can give the answer? How about that? Miles is our director of asset management operations as well. So, not to put you in the hot seat, Miles, but maybe this is up your alley.
Yeah, absolutely. I mean, I think that it's always best to speak from a ground level perspective and on what we're seeing at that level. So we are seeing rents start to increase even now, although it's slight. Omar basically put that out there that are we at the bottom of the cycle? I think it's difficult to say, but for the last 6 months, we are seeing rents trickle upward and consistently upward. So over the next 3 to 5 years, where we end up, I don't know exactly. I think the biggest value add here is that we're finding properties at a low basis. That is the biggest value add in all of this. You're coming in as an investor at a low basis. We will, as the cycle rebounds, we will be able to rebound on rent. Will it be like 2022 when we were able to renovate a unit and increase rent by $300, Omar? I don't believe so,
I don't really
but
think so.
that's not how we're underwriting these deals or looking at them, frankly. It's a complete
100%.
yeah, it's a completely different viewpoint on how to look at these deals. We're not
Yeah.
saying, hey, everyone, we're going to put $10,000 into this unit and increase the rent by $400. No, these deals work because they're performing already and they don't have the risk of renovation. They're already performing admirably. They just have a capital stack issue.
Yeah, and look, with regards to data sources, a lot of these are, say, publicly available. You can go to your comparables websites and do all of that stuff. We also have databases like CoStar, Yardi Matrix. We use them. We also have our own internal data. So we're in a couple of markets. We already are doing all the comp analysis. So we have our own database that helps us with that. And lastly, what we also see is not just say the rents around us. What we're also seeing are stuff like, okay, if I put $1,000 into repairs and maintenance, if I put $10,000 into capex, what is the expected range of outcomes that I'm getting in a combination of various submarkets for different types and profiles of assets that helps us to triangulate an answer much more than say, hey, here's a rule of thumb, you put in 5 grand and you get Y. You put X and you get Y,
Mhm.
right? So it's a combination of looking at data sources that are publicly available, subscribing to databases like CoStar, Yardi, all of that, but then also using our internal data to benchmark not just where we set the rents, but also how do we have a business plan for these assets.
Perfect.
Anything else?
I don't see any more questions. I think everybody has endured this webinar admirably. Thank you. I don't think there's anybody else. Omar, was there anything that you wanted to say, parting words regarding this
No,
topic?
nothing from my side. Look, guys, if there's anything you're hazing on, stuff you need to know more about, say it once more time. Reach out to us, Miles at Boardwalk Wealth, and we'd be more than happy to assist you.
Perfect. Thanks, everybody.
Thank you, everyone.
Bye.
Bye.